Welcome back to our YouTube channel. Today we're going to be talking about interest rate buy down. We're going to talk about what is it, what are the benefits, and how do you qualify for it. Stay tuned. So I am here with the loan officer, David, from Mortal Mortgage. Man,
how are you, Nelson?
How you doing today? Good to see you.
Great.
Thank you for taking the time.
Absolutely.
We've been wanting to do this now for a little bit, so finally we got here.
2024.
2024. So having said that, make sure you guys are following because we're gonna be putting a lot of videos, a lot of good information, home buying tips on everything. From loan, from appraisal, from inspection, from everything. So make sure that you follow us. So we're talking about buy down. Tell me, what is it?
So a buy down allows the buyer to get a lower start rate on their initial payment.
Okay.
So we're going to be going over, it's a 3-2-1 buy down, a 2-1 buy down, and a 1-1 buy down, and what needs to occur in that process.
Gotcha. So 3, 2, 1. So is that first year, second year, third year?
Correct.
Okay.
So let's say, for instance, you go through the normal pre-approval process. You send your W-2s and paycheck stubs if you work for somebody, or if you're self-employed, 1 or 2 years of tax returns, along with bank statements for both buyers. So then we would pre-qualify you based on today's note rate. So hypothetically, let's say you qualify, the pre-approval is done for a 6.5% interest rate. To be able to get the buy down, the seller has to contribute a specific amount for each one. So obviously for the 3-2-1 buy down, the seller concession is going to have to be more, and for the 1-1 buy down, it's going to be less.
Fantastic.
So to your question, a 3-2-1 buy down, let's say hypothetically you qualify for a 6.5% interest rate, right?
Okay.
So for the first year, if the seller is able to contribute, normally that's around 3 to 4% towards the buyer's closing costs. Then it'll allow them to get an interest rate the first year 3% lower than the note rate.
Fantastic.
So you're talking about 3.5% for the first year. Then year 2, you're at 4.5%. Year 3, you're at 5.5%, and once that 3 years is over, you go to the original note rate of 6.5.
Fantastic, very good. Are there any requirements from the buyer in order to qualify for that program? I'm talking about income, FICO requirements, anything that they have to have in order to qualify for this?
Well, they have to qualify for a normal loan. So for credit score, we need at least a 620 or 640 for a conventional loan. FHA does go down lower. They're about a 580 to a 600. So you just have to qualify for that specific program, whether it's conventional, FHA, VA, or USDA. And then we take the note rate from that program, and then that's when we put into an Excel spreadsheet the purchase price, the down payment, the current note rate that they qualify for, and then it breaks each category down to a 3-2-1, a 2-1, and a 1-1 buy down.
Gotcha. Very good. All right. So let's look at the benefits, right? I mean, besides an amazing rate, especially the first year, right?
Absolutely.
Can you see benefits from the seller's side?
So absolutely. I mean, it benefits both the buyer and the seller.
Okay.
So let's start with the seller.
Okay.
So instead of reducing the purchase price, so let's say, for instance, purchase price $600,000,
okay,
and they reduce the purchase price to $585,000. It's going to negatively affect the market as well, because now the home is selling for less than it was listed.
True.
So if the seller decides, instead of reducing that house, let's say it takes it from 600 to 585, instead of just reducing the price, that 15,000, you can offer that to the buyer.
Leave it as right.
And then the home is going to be registered as sold at 600,000, which continues to keep home values where they're going, and it benefits the buyer because now they can use that 15,000 towards the buy down or towards closing costs, or actually both. You can actually do the 1-1, which is generally less than 1% of the purchase price, and then use the other 1% for cost. So it all depends on what's going to benefit you the most.
Right. And seller concessions, we do it all the time. So I mean, there's a lot of things that we can go to the seller, explain the program if they're not aware of it. But a seller concession, it's something that we do very typical.
Absolutely.
So it's not, we're not asking for something here out of the world.
No.
It's something standard that we do. Fantastic. So, man, before I forget, if you're actually watching this video, because I know you're going to be doing a live training.
Yes,
and
we are.
There's a lot of information in this topic here.
Correct.
So you're going to be doing a live training, and you said it was okay for us to come in and actually live stream the training. So it's going to be held here, and it's going to be for realtors, for everybody. So if you're a realtor or a buyer or seller, great opportunity. Come in. We're gonna do it live, and you will have the opportunity to actually ask questions live, and we'll go ahead and relay that to you. You're gonna be answering that. So tell me, when are we doing this?
Yeah, so we're going to be doing a live training in our Remax Motto office in Harrison Street in Hollywood.
Awesome.
On January 31st at noon. We'll be giving you a more in-depth understanding of the program, how it works, what the seller needs to contribute. And Nelson, going back to your point, how it benefits the buyer, is that not only is the buyer going to get a lower start rate, but they're going to actually be able to use those funds that are held in that escrow account if they refinance within year 1, year 2, or year 3 to reduce their principal balance. So anything that's left over, it's there for them, to reduce their loan balance.
So you bring a very good point. So let's say that person buys the house, and a year after they decide to sell the house, something changed. They want to go out of state, or something happened.
Yeah.
So in that case, then that money will be used towards.
Correct. It's used towards reducing their principal balance. So
Fantastic.
Unlike discount
gotcha.
points where you buy the rate down a quarter, a half a point, or maybe 3/4 of a point to a point, that money is gone at your closing. With this buy down, they're going to keep it in an escrow account at the lender. So every month when you make that reduced payment, they're taking money out of that account to cover the difference of your payment. So it's not like you're paying less than interest or principal.
Right.
They're using that to cover. So let's say you do a 3-2-1 buy down. Year 1, you start at 3.5, and rates drop down towards the end of the year and next year. Whatever's left over in that account, they're going to reduce your principal balance. So, I mean, it's a win-win for everybody.
I like that.
It's a win-win.
I like that a lot.
Yeah.
All right. So, if you don't mind, what I'm going to do is I'm going to put all your contact information and on the description on the bottom. So, if you have a question, you cannot attend that live stream, and you have additional questions, go ahead and reach out to David directly.
I'm sorry.
No, I know you're awesome. I know you're always willing and able to answer anything. So is that okay if I'm gonna go if I share all the contact info for you?
Absolutely. It's David Iannucci at mottomortgage.com.